Greetings. Hi. Welcome back to the continuing lecture in business math. This is Dr. Jeff Hong, and our today's topic is depreciation. So let me first start with sharing this PowerPoint file in front of me. I hope you're also, yep, looking at the same file. Of course, this file is all, posted in the Blackboard, especially in the currently in the temporary folder. But everybody should have noticed that all the past lecture notes can be found in the lecture notes folder. Okay, um, so when we say depreciation, I guess everyone pretty much has semantic understanding of what depreciation is. Of course, the semantics is not the semantics is not the reason for what we do in this class. And if everything can be answered by the semantics, then there's no need for any expertise or no. All you need to do is just have a good um, uh, book of lexicology or dictionary or thesaurus, and then you would have the definition or the meanings of the words. And if that is all, then there's no need for computer programming, or there's no need for uh, legal studies, or there's no need for physics, or no need for math, right? So of course, I'm not trying to make little of semantics. Especially uh, speaking in terms of linguistics, right? Semantics in Chomskyan linguistics is a really respectable discipline. It's more like computer programming. I don't know if you know anything about the linguistics, especially Chomskyan linguistics, but Chomskyan linguistics is more like computer language. But anyway, so when we say depreciation, people easily understand. Oh well, it's decrease in value. Of course, and people understand that any if you have a car, right? Of course, over time, the car loses value because it goes without saying, an old car, 5-year-old car, is obviously, worth much less than, a brand new car in mint condition, right? And you call that depreciation. That's true. That's just the everyday usage of the word depreciation. That's what I'm calling semantics. It's just the meaning of the word. Once again, if you are happy with the meaning of the word, just stick to, and if you want to stick to that, very low level of human intellect, right? Just knowing the words, that's the best thing you can do. If that's the best, maximum you can do, or the best intellectual activity you can think of, then that's very, I have to break a very bad news to you. That is, very um, elementary. That is very, very rudimentary, and that's That's not intellectual activity at all, right? Some people think probably and feel, very proud about themselves, or they are pretentious, in a way. They sit in a bench, in a park, and picking up a novel, small storybook, and read it, and they feel very intelligent about themselves. No, that's just a um, that's something you see in the movie, right? That's something um, maybe back in the 1960s, 50s, just reading a book is a sign of uh, intellect, right? Regardless of what book it is, if it is a book about, physics, math, if it is a book about science, then that would be a sign of intellect. But if it is just a like novel, essays, poetry, I don't think it is really, it tells much about the intellect. It's just anybody can enjoy reading a novel, right? It doesn't take that much intelligence to, enjoy a uh, an essay, or I mean, it's a reflective piece of writing, that goes without saying. Reflective piece of writing, right? And um, some people like to have reflective moments, but reflective about what? Reflective about the social phenomenon. Why, some deep issues, like why there is such a um, irrecon, um, you know, uh, deep divide within the U.S. society. Huh? A reflective thinking about something like that, or almost irreconcilable, completely irreconcilable divide, right? Between the urban America and rural America, between the um, coastal U.S. coastal cities, and um, uh, you know middle America, or midland. It's rather the divide between, not between the race. I mean, there is certainly divide between the races, but it's not uh, the divide between the uh, income, uh, different income groups. I mean, completely irreconcilable. There's no reconciliation between the Democrats and Republicans. I mean, reflective. When I say reflective thinking, I mean, when they say reflective thinking, is it a reflective thinking about that? That would really take, that would take intellectual activity. But just reading a novel, reading a poetry, and light reading, not a very heady reading, but a very light reading, and they just sit at the bench in a park and just, and then have a reflective thinking about just reading a novel, some poems, and they think, oh, they are having a reflective. I'm having a reflective thinking about the meaning of life, blah blah blah. Those things. I'm sorry, I feel very sarcastic about it, and I admit it. But that's not an intellectual activity. I'm telling you, that's a very minimal. I mean, of course, without cannot do that uh, either without some degree of intelligence. But I'm telling you, that's not really. It doesn't take. Those are not the activities that would take really a lot of, intellect, right? So as opposed to that, if you're really doing a reflective thinking on, like a scientific matters, or, like physics, or, mathematical issues, deep, which really, really require, really, really, deep reflective thinking and logical reasoning and analytical thinking and critical thinking. Unless you are doing something like that, right? Just having a lot of large vocabulary, having, um, uh, of course, having a large vocabulary is, of course, but still, that's the beginning of the, intellectual activity. But, uh, not that large vocabulary. What type of, words are in that vocabulary? That's what matters. If you have um, a lot of, scientific and philosophical, or, legal lexicon in your vocabulary, then that would that would be a whole different story. But if you only have, a lot of adjectives, a lot of, uh, a lot of lexicons, that a lot of words that are just for the, the purpose of describing, one's emotions, feelings, all those things, then that is not really useful vocabulary. Understand? I mean, it would be useful for that, particular purpose, but uh, not to get yourself ahead of others, or not to, that doesn't really do much to um, get yourself ahead. You understand? Uh, so, that was a little, digression from the main topic. But, the reason I digressed a lot from the main topic is because of the word depreciation. And you think you understand the word depreciation. Of course, you understand it in everyday usage of the word. Just because you know the semantics, what I'm trying to say is, just because you know the semantics of the word, um, that's not the good enough reason to feel complacent about it. You understand? Because depending on what context it is being used in, it can have so much, different implications and ramifications. Okay? So, for example, here, the depreciation, forget about the meaning of the word depreciation that you know about. Why? First of all, your car depreciates. Yes, true. If you have a 5-year-old car, the value of five-year-old car um, must have depreciated a lot from, when it was just, at time zero, right? That goes without saying. But your personal vehicle is not recorded in the balance sheet, or it's not recorded in the its depreciation is not recorded in the income statement, because you don't have balance sheet or income statement, because you aren't a person. Is just you're just an individual. You're not a business. But if you are a business, I mean, even if you're just one self-employed one-man operation, right? If you're a if you declare yourself if you declare yourself as self-employed for tax purpose, right? You can now, and you can keep your balance sheet and income statement, that, and because you are self-employed and you're a so you are a business. I mean, you have a sole proprietorship. Of course, you have to register the business. And let's say you you operate a one person cleaning service uh, operation, right? You register that business as a with the county, and then register, and then you have business name, you have tax um EIN. I believe it's uh, like taxpayer ID number. As an individual, your social security number is your taxpayer ID, but as a business, it's called EIN. And I forgot what that E stands for. Probably employer uh, identification number or something. But if you are, even if you have no employee and you're self-employed and sole proprietorship, a one-person operation, and let's say you are operating a professional cleaning service business. Okay, so actually, then, or party, planner. You're a party planner, right? One sole proprietorship. One person operation. You are the CEO. You are the janitor. You are the secretary. You play all those. You assume all those roles. And this is a sole proprietorship. And you have a business name. Registered with a county. So once you have declared as a business, right? Then your car will depreciate. Your car will be then declared as business, as a vehicle for business, right? Business. So your car is a business asset because your car is being used for business. Okay. Then your car will now depreciate according to an artificial schedule. According to an artificial schedule. Okay. In other words, a personal vehicle uh, depreciation for a personal vehicle um, has no use for tax. It doesn't have any tax purpose. You understand? First of all, but if your vehicle, the same personal car, but it is now being used for your business, which is officially approved by the county, registered, officially registered with the county. Then your your car is a business vehicle, right? Being used for business purpose, right? And then your car will be depreciated uh, according to an artificial schedule, and then it will be um, its depreciation will be recorded in the balance sheet, and the depreciation will be recorded in the income statement as part of an operating expense, OPEX. Okay, so this is how depreciation, the word, completely transformed into a something else than what you generally understand as, right? Depending on the context it is being used, because your personal car is not a business asset, right? It's not a business asset. So there's no there's no tax deduction for that. I mean, your personal vehicle, what it means, depreciation for your personal vehicle simply means aging of the car, right? Understand? Of course, with the aging, in the market, let's say you had a car that was $50,000 car at the time of the purchase. When you bought the car, and this is your personal vehicle, so at time zero, it was $50,000. But 1 year later, 2 years, 3 years later, of course, the car will lose value drastically first in the first year. I mean, the minute the minute you take it out of uh, the dealership, right? The minute you take it out of the dealer's lot, it already loses value by thousands of dollars, right? Although it didn't even put, 10 miles on it, okay? Um, but anyway, with the usage, it loses value because there's wear and tear. That goes without saying. But 3 years later, um, uh, it will still have resale value. I mean, if you're selling it, right, it will reflect the age of the car and how uh, how well you maintained it or how roughly you used it, right? If you took a very good care of the car, even 3 years later, it will still have a lot of mileage left. I mean, uh, you took a very good care of the car. It will still be in a mint condition, right? Um, the oil was changed. You changed oil every 3,000 miles. You didn't put a lot of miles on it. So even 5 years later, it is still, it has less than 5,000 miles on it, right? Your car was your baby. So you took a very good care. A nice coat of wax and a protective coating, and right. So even 5 years later, 5 years ago when you first bought it, it was $50,000. Even 5 years later in the market, the resale value would reflect how well maintained the car is, right? How well the car has been maintained, right? So even 5 years later, with minimal miles on the odometer, um, and less than 5,000 miles on the other, it's like 1,000 miles every year. Um, Everything is in mint condition. It could probably sell for $30,000 even 5 years later, right? And the more resale value it has, and that's what you want, isn't it right? If it's your personal car. But look, this is why it is different. If it is a business asset, you don't want a lot of resale value left on it. Listen, what I'm saying is on the book, in the book, right? In other words, on the balance sheet, 5 years later, you want the remaining value of the car to be exactly zero or just a scrap metal value. Okay, 5 years later is called salvage value. You want only the salvage value left, and salvage value would be either scrap metal value or zero. Okay, so this is quite counterintuitive, isn't it right? I mean, it defies all your logic and reasoning. Why would you want your car to be valued at zero or just valued for scrap metals only? Huh? Of course, you wouldn't want that, right? But on the book, right? On the balance sheet, you want it to be recorded for scrap metal value or as $0. Okay, so once if you're smart, you would already you must have got the logic behind it. You would understand. Oh, you want only artificially. You want that to be zero only artificially. Yes, in the book, you want it to be artificially zero. And in real life, you want it to be valued as much as it can be. You understand? Huh? If this is your company vehicle, right? A company car, I mean, car for your business, right? For business as a business asset. Of course, 5 years later, taking, if you have been taking a very good care of the car would be still in a very nice condition, and you want to resell it, right? And you want to get the maximum. You want to get the maximum value on that car if you are reselling it, right? If you're selling it in the market, right? Even 5 years later, right? But what is recorded in the book has nothing to do with that. What is recorded in the book is completely a different story, right? Why? It's because um, depreciation of business asset has two aspects. One, cost recovery, right? Uh, Second, the tax implication. Now, think of it this way. Of course, uh, the idea is, what is the service life of a car? How many years do you think it is? Of course, you would say, doesn't it depend on how well you take care of it? Yes, yes, of course. It depends on how well you take care of it. So if you take a very good care of it, the car can last even 10 years, 20 years, right? 30 years. Mhm. If it is even, more than 30 years old, then, it could qualify as a collectible, a classic collectible car. But um, the point is, uh, the service life of a car depends on, how you treat it. But that's the reality, right? That's uh, the actual real aspect of the car. But um, if this car is your, business asset, vehicle being used for your business, then uh, recording the value of the car in the balance sheet, right, has nothing to do with the reality of the car, but it just follows a uh, completely artificial schedule. In other words, on the balance sheet, your car has a predetermined service life of 5 years. Okay, predetermined by the tax law. Okay, so predetermined means most vehicles are like 5 year. The service life of the car, let's say 5 years. What does that mean? That means if this car was $50,000 at time zero when it was purchased, right? Then 5 years later, at time five, this car will, the value of this car will reduce to zero or just to scrap metal value, scrap metal, right? So what does that mean? The car will have fully depreciated on the balance sheet. The car will have fully depreciated. Okay. Um, so in other words, when the service life is up, the car should expire. Anything, think about it. Anything when the service life is done, it should expire. Isn't it right? The light bulbs. If the light bulb, when you buy a light bulb, it will say on the box, uh, how many hours it can last, right? Oh, that's manufacturer service life, right? I mean, manufacturer uh, that comes with the manufacturer's warranty. Now, of course, the manufacturer would give you a warranty, like 5 years, 50,000 miles, 10 years, 100,000 miles. Does that mean it is a service life? Once again, manufacturer's warranted service life is different from the service life uh, pre-designated by IRS. Okay, and the service life predetermined by IRS is much shorter than manufacturer's service life, warranty service life. Okay, and the reason for that is, now let's think about it. So we are all talking about as depreciation of business asset is all artificial, follows artificial schedule. Okay, which doesn't reflect reality, which has nothing to do with the reality. Your business, your car for your business may be still, very good and in mint condition even 5 years later, and may resell for $30,000 in the market. Okay, that's the reality, right? But forget about the reality. The in the in the book, right, on balance sheet, it will have lived out its life, so it will have expired, so its remaining value should be zero, right? And what does that mean, living out its service life? Think about it. Anything that has lived out its service life will should have completely disintegrated. Isn't it right? I mean, if you have used it well, suppose your shoes, nobody wears shoes, until it disintegrates. But think about it. If you wear your shoes until until they disintegrate, then what does that mean? Those shoes have lived out fully their usefulness, right? Makes sense. If they were really, really fully utilized, then they should turn into just scraps, right? That's the idea. I mean, if the business asset has fully lived out its life and lived up to the full usefulness of its purpose, right? Then it must it must have disintegrated, right? Makes sense. That's why scrap metal value, right? As the book value of, so we're talking about the book value, not actual market value, right? Um, so depreciation follows an artificial schedule, right? Service life of asset is predetermined, right? All the assets, I mean, for business assets like, production equipment, right? Machinery, production equipment. Think about it. With with the usage, they wear and tear. Makes sense? Aging brings aging, with aging comes wear and tear, right? And also, it's only natural that the production equipment or machinery uh, loses value with the usage because of wear and tear. And with wear and tear, right, the production capacity goes down, right? Makes sense? Think about an air conditioner. When you buy a new air conditioner, right, what do you notice? You notice nothing except, the room uh, gets cool very quickly and it's quiet, first of all. That's why you don't know. That's why you don't notice anything because it's quiet, right? And then after turning on the AC, like 10 minutes after turning on the AC, the entire room is very cool, right? And it's very quiet. And it's at the beginning is energy efficient, right? Your energy bill, right? It doesn't use too much electricity, so your energy bill is very, low. But suppose you've been using it for 5 years, 6 years, 7 years. What do you notice? Hmm? Obviously, you notice something, right? Why? First thing you notice is the noise. There's a clunk. There's a clunking noise. The minute you turn it on, there's that uh, you know low frequency noise, which is generally called white noise, and uh, then you notice some clunking noise. It becomes a clunker, right? Two, the second thing you notice is that the room doesn't get cool, right? You run it for a long time, but the room temperature isn't that lower than the outside temperature, right? Despite all the noise. Three, you notice that your energy bill is now suddenly very high. I mean, uh, your it it's using up more electricity, it's using up more energy, right? Just to drop the temperature by 1 degree, the same uh, for dropping the same degree as before when it was new. It uses more electricity, so your energy bill goes up. You notice all these things with wear and tear and with aging. That means the productivity of the air conditioner has drastically dropped. Okay, so of course, it is only natural that you keep recording the changes in the uh, value of assets, changing value of assets as time goes on in the book, in the balance sheet, right? Because uh, your asset won't be maintaining the same value as the day one because your production equipment will become uh, less productive with age and with wear and tear, right? It will become less productive. So you cannot, uh, you will have to reflect that decreasing value, which is, of your fixed assets. That's why it's called depreciation. But, once again, it's all very artificial. Now, the second aspect. So first, it is recorded. Depreciation enters the balance sheet, right? In the fixed asset or the non-current assets section. So it reduces each year. It will reduce, right? So it's a negative number. It will reduce your total fixed assets value by as much as annual depreciation amount. Now, second, where does the depreciation again appear? It appears it will show up in the income statement as well, right? Those quarterly depreciations and annual depreciation will uh, show up in the operating in the income statement, especially in the operating expense section, OPEX section, right? Now, but when it shows in the OPEX section, why? I mean, why is it an expense? I mean, you bought the asset, you bought a car, you bought machinery and equipment for your business, or you bought air conditioner for your business, for your office. So they are recorded in the as assets, and then they lose value over time because they wear and tear, right? So the value goes down. But why in the operating expenses section? Why OPEX section? Why in the income statement? Well, of course, it's an expense. Why? First of all, you paid you paid money, right? To buy that car, you paid $50,000, right? Of course, so it's an expense. You have to record that expense, right? From that transaction, you bought the car, right? You paid, 50,000. Of course, there are a couple of ways you can do this, right? One, I mean, a couple of ways you can make that payment. One, of course, you can pay, if you have 50,000, you can pay lump sum, right? Just out of your pocket. But nobody does this, right? I've been telling, this is why in the time value of money, there was a car financing example, remember, right? And then in that example, I said, yeah, you can buy a car. I mean, you can pay with your, pay lump sum cash, right? Just write a check for 50,000 and the money comes out of your bank. But I told you, nobody does this. Even if you are, a billionaire, you don't just buy. You can do that. You can afford to pay $50,000 if you're a billionaire. It's just a piece of, it's a peanut maybe, but still, a smart person wouldn't do that. Why? You can finance it, right? You just make a down payment, right? And the balance will be paid by the bank. And from there on, uh, the bank is, you owe the bank, right, the financed amount, right? You make, monthly payments. And then I told you, you're doing this because as long as the interest, you have interest you pay on that financing is lower than the return on the investment that you can make with the money that you borrowed. In other words, you have money. I mean, for $50,000 car, let's say you make a down payment of 10,000, 40,000. You could have paid it, but 40,000 you borrow from the bank and pay, let's say, 5% interest annually on that. But so you didn't use your money, but your money, $40,000, you put it in the stock, right? In the stock market. And then on average, let's say you earn 10% return from the stock market. Then what's your choice? I mean, any sensible person would finance it because earning 10% a year with that $40,000 can more than pay for itself. Isn't that right? I mean, the interest can be paid, right? In other words, a loan, $40,000 loan, more than pays for itself because um, with 10% return from the stock market, you can more than pay for the interest and then still have 5% left over every year, right? Makes sense. So you would finance it, but then think about it. which is the most common way of buying a car. But suppose you bought it, with upfront. You bought it, you paid cash upfront, so $50,000 paid full in cash. Now, because you paid $50,000, you must record this transaction. I mean, this is a cash outflow, isn't it right? It was an expense, so you have to record that expense, right? You have to write it off as expense. So that must be recorded in the income statement because this is an expense, right? But then where would you, I mean, this is a one-time expense, right? Of course, this is not part of the, direct cost, because direct cost is cost of, what? Uh, um, Direct inputs, right? Like capital, labor, raw material. So this is not any of those. So this will have to be recorded in the operating expenses, right? But then, OPEX, I told you, it's relatively a constant amount. This is just a one-time expense, right? But, you will see later that it's going to be a part of the constant expense. But so if you record it if you enter it in the income statement, when do you do that? What year? Of course, in the year that you made that expense, in the year in the year that you incurred that expense. So at time zero, right? In other words, I mean, in the year one, right? In the income statement of the year one, the first year, you would write it off, right, as expense. But here's the thing: if you uh, write $50,000 as expense, right? What does that do to your EBIT? Think about it. In the income statement, the first thing is, revenue, right? Two sources of income: sales revenue and investment income, right? And then two sources of expenses: direct cost, or CGS. That's the first thing. Second thing, indirect cost, or OPEX, right? So think about it. And then you subtract the expenses from income, and you arrive at what? If you subtract expenses from income, that's called operating income or operating profit, right? Another name is what? EBIT, right? Okay, I hope you haven't forgotten this already, because that wasn't that long ago. Earnings before interest and taxes, right? So obviously, if expense goes up by 50K, that means EBIT goes down by 50K, right? Makes sense? Anything that makes expenses go up by 50K will reduce EBIT by 50K. Makes sense? And EBIT goes down, if EBIT goes down by 50K, what happens to the EBT? EBT also goes down by 50K, right? Of course, it doesn't go down directly by 50K because, from EBIT, interest payment is taken out, interest payment is gone. So EBIT, but, anyway, by as much magnitude, right, it will reduce the EBT. But then if EBT goes down, what goes down too? If EBIT goes down, EBIT is, and that, EBT is earnings before taxes. So if EBT goes down, what goes down too? tax goes down too, right? Isn't that right? Tax goes down too. So then this is why, you know, first of all, this is why interest is called business expense, because by as much as interest payment, taxable income or EBT goes down, right? But even before that, um, all business expenses reduces your taxable income. Suppose your expenses are zero, then all your revenue will be, and suppose you have no debt, so you don't pay any interest. What does then what does what does that what does that make the EB? And what does that do to EBT? In other words, your entire income becomes taxable income, right? Your entire gross income becomes taxable income. Make sense? So um, think about it. Um, Expenses, interest, payment, all those elements, by being subtracted from the income, mainly sales revenue, reduces your taxable income or EBT. Make sense? Now, suppose if it is just one company, your business, that wants to write off this $50,000 in year one, in the year that this purchase happened. Well, it may not be it may not um, it may not you know stop IRS. It may not bring IRS to make IRS grind to halt. But suppose all of the there are like hundreds of thousands of businesses across the United States, hundreds of thousands of businesses, large or small, and all of these businesses makes some capital purchase during any given year, right? The capital purchase could be like a car, like $50,000, or it could be uh, uh, hundreds of millions of dollars to build a new plant, right? Like plant and equipment, right? So then think about it. None of these capital purchases, right? None of these capital purchases require IRS's approval, right? They don't require IRS approval. It's completely spontaneous. I mean, you buy a car because you need a car for your business, right? You don't you don't ask for IRS approval for that, right? So IRS has no idea what a big ticket capital purchase any there's hundreds of thousands of businesses have planned, right? They will, so without like prior knowledge of what their tax write-offs their expense write-offs will be when IRS think about it, uh, how would IRS know that in 2020 the businesses would make such and such and such capital purchase, right? So in other words, this causes a huge deterrence or hurdle. I mean, huge um, uh, hurdle, what else? To IRS's forecast of future tax revenue. You understand? Because IRS never knew hundreds of thousands of, what these hundreds of thousands of businesses have planned for, to buy in 2020. And when in 2021, there will be a tax time, again, April 15th. And um, when the businesses, file taxes, and of course they will have paid already, some taxes in advance, but April 15th is to make adjustment to the prepaid taxes, right? So if all of the businesses in this country, in the U.S., uh, write off these expenses for, in their, income statement in 2020, then there will be lots of, IRS forecast what the reality, of the actual tax revenue uh, from 2020 will be wildly different from the forecast, right? Revenue forecast. And this causes a lot of chaos. And there will be lots of, dips and spikes, in the uh, uh, actual tax revenue, right? Because uh, I mean, the forecast is always something, smooth. You cannot make a forecast. You cannot make a forecast uh, that would have, dips and spikes and dips and spikes. Forecast is a trend line, right? A trend line is a straight line. So, of course, the reality would deviate from the trend line, a straight line. But then, uh, even though the actual um, data differs from the forecast, but the deviation or the forecast uh, forecast error uh, shouldn't be that big. But if there are constantly dips and spikes, dips and huge, um, completely, irreconcilable differences, right, in the between the forecast and the actual, right, then uh, this will be a problem. It will create a chaos because what is the purpose of tax revenue? I mean, IRS is not the IRS is only collecting taxes, not but IRS is not the one using taxes, right? Who uses those taxes? Federal government, right? Federal government. So federal government will have to uh, budget they will have to uh, they will have to make a budget, right? They will have to do the budgeting of the future uh, government spending, right? From 2020 tax revenue, they will have to plan ahead and budget 2021 government spending, government expenditure, right? So if the forecast is, completely, unreliable, and there are, too much, dips and spikes in the actual tax revenue, then there can be no budgeting. There's no um, so what solution did they come up with? The solution is, don't you you bought a car and the car um, you paid 50,000 for the car, but don't write it off in year one. Instead, spread it over 5 years. Spread it over 5 years. Then each year you only write off 10K, 10K, 10K each year, right? Just 10K over 5 years. So then what what effect does it have? The effect is the result will be uh, IRS's tax revenue forecast will be uh, the actual revenue stream will be smoothed out. You understand? Because there is no random, erratic dips and spikes anymore in actual revenue stream. So uh, the actual tax revenue stream will, coincide more with the forecast, right? Tax revenue forecast. So this is the other side of it. This is the other aspect of depreciation. I mean, it's not just reflecting the declining value of the assets, but to um, make the businesses write off the expenses, not at once, expenses for capital purchase, uh, not at once, but by making them spread it over an extended period of time. Of course, depending on the assets, this timeline would be different. For example, car, as I said, for vehicles, like passenger vehicles or SUVs, pickup trucks, about 5 years. 5 years is the service life. So, as I said, in reality, it doesn't mean that in 5 years your car will completely expire. Your car in reality will be okay still, but in the book, you depreciate over the service life of the asset. Okay, makes sense. Hmm. So that uh, the writing off of this expense will be spread over 5 years, which will basically reduce the drastic, fluctuation in actual tax revenue, right? The dips and spikes to avoid that. And there's another, and of course you're thinking, oh, so then the benefit is mostly to IRS. Not necessarily. I mean, it's yes, true. The IRS will have less chaotic. IRS will have less chaos, but then also for your business, it also has it also brings in a benefit. Why? First of all, in year one, you paid $50,000 in year one actually, but and in reality, you don't really do because you remember by financing you make monthly payments, so you don't really pay out $50,000 in year one. But if you did, um, you write off only $10,000 in year one, so you have less tax shelter, you have less uh, uh, tax savings. In other words, if you write off $50,000 in year one, you will have a lot of tax savings, right? But you write off only 50,000, so you don't have as much tax savings in year one. But from year two through year five, think about it, you'll have additional tax savings of $10,000. Why? Because in year one, there's $10,000 that you didn't spend in year two, right? Year three, you're writing off $10,000 that you didn't really incur in year three. Year four, you're writing off $10,000 that you didn't really incur in year four. Make sense? In other words, there is additional 10K, 10K, 10K that you didn't really uh, spend from year 2 through year 5, but you write it off in those years. So from year 2 through year 5, it makes it look like your expenses are greater by $10,000 than it really is. So if your expenses look greater by $10,000 than it really is, what does that mean? Your taxable income will be less by $10,000 than it really is. Make sense? Your EBT, or taxable income, will look only $10,000 less than what really is. And so if it looks $10,000 less than it really is, then your taxes will be less by as much, by the same magnitude. Right? Makes sense? So you are saving on taxes from year 2 through year 5. So then there's also a benefit, in a way, uh, for the businesses as well. But of course, if possible, all the businesses want to, if possible, they want to write it off in year 1. Then you might wonder, why? I mean, isn't that the same thing? I mean, in year 1, if you write off $50,000 as expense in year 1, then you get, your taxable income will be lower by 50K. You pay, you know, you pay less taxes by as much as that. Or or each year you pay, your taxable income becomes $10,000 less, right? Than they really are. In other words, these $10,000 from year 2, 3, year 5 are like, ghost expense, phantom expense. It's phantom. It's not really there, but it works like, as if the expenses were uh, you know, incurred in those years, right? So I mean, then that's why they say, depreciation is a non-cash layout. Non-cash layout. What that means is, from year 2 through year 5, there was no actual cash spent, no actual cash spending of $10,000, but you have them like, as if you did. Okay, then still the question is, what's the difference? Anyway, the total of all those, write-offs, year 1 through year 5, is still 50,000. And whether write off entire 50,000 in year 1, or whether you're over 5 years, what's the difference? You think they are the same thing? Really? Huh? Why? And I told you, most companies want to write it off in year 1 if possible. What's keeping them from writing off in year 1 is the IRS rule for, depreciation. So if all the companies prefer to write it off in year 1, obviously that means they are not the same, right? Writing off the lump sum $50,000 in year 1 and writing it off, spread over 5 years, they are not the same. Now, why? You should be able to tell why. Because after all we have done, you should have a very good explanation, logical explanation to why businesses prefer to write it off in year one, if possible. Okay? Now, that I leave that question as food for thought, right, for you to answer in the next class. Okay? I want you to write your answer in the next class when you log in and report in the discussion board, right? When you report your attendance in the discussion board, in the forum, right? Please give your answer, write your answer in that, as you report your attendance in your thread, please write your answer. Okay? If you give me a correct answer, I will consider a extra point. All right? Okay. So that's it for today. And thank you for watching. I will see you guys in the next class.